The following is an informational brief on sensitivity analysis, an overview in its financial application. Authored and narrated by Matthew A. Gibson, a graduate student of American Military University, and presented to Dr. Tracy D. Fisher, and for the class Fundamentals of Business Analysis. To begin, what is sensitivity analysis? It is a method of what-if testing within a business case. As Irons defines, a business case is a set of assumptions about a business activity that a company might undertake. It affords the ability to change independent variables to check for positive or negative effects on a dependent variable within a financial model. It is through the effects of the independent variables that conclusions can be drawn from and decisions made on the subsequent effects on the dependent variables. Through one-time analysis of independent variables. It is through this that criticality is revealed for one or more of the independent variables. Much like a physician performing an assessment on a patient, this stepped approach allows for one or more independent variables to be identified. More than one area is mentioned for more than one independent variable may be susceptible to the proposed forecasted inputs. If one or more of the independent variables is too adversely affected, management will want to weigh this in their final determination. And sensitivity analysis also helps understand uncertainties, limitations, and scope of the business case predicted through the application of impact-driven reasoning. In other words, this is cause and effect. If a firm does this or the market turns that, are we, as the firm, willing to accept the outcome? The purpose of sensitivity analysis aids in decision-making, adds credibility to business case through testing, reveals the most vulnerable areas within the business of those independent variables tested for leaders to harden. The word harden here is used for management to be afforded the ability to reinforce the susceptible area of business in order to make it less vulnerable to the proposed inputs. And the results are prediction-based, not empirical, but represent conclusions rooted in the careful effort behind the forecasting computations. As with any forecast, when it comes to the future, nothing is certain. This is not purely an exercise. This is careful consideration of the business's future, rooted in the scientific method, but it is not certain. This, as well as other methods of analysis, seeks to educate and that all decisions that are to be rendered are done so after the wargaming has occurred. No one wants to be an investor, let alone an employee, if a firm leaves its financial decisions to chance or the proverbial toss of a coin. Capital Budgeting Principles Incorporated. Although likely a functional name for an accounting firm, the incorporation of capital budgeting into the sensitivity analysis allows for additional inputs to be considered and risk to be measured. Capital budgeting focuses on cash flows within the firm that can be earmarked, planned, and forecasted for the purposes of growing a particular segment of the business. The time value of money is certainly in effect here. For the first fundamental principle of finance dictates that the value of any asset is equal to the present value of the cash flows the asset is expected to produce over its economic life. The successful business pours money into projects that over the project's lifespan pays for itself. The really successful business invests in projects that also create additional cash flow to offset other business liabilities and allows for future expansion. Capital budgeting is concerned with cash flows as opposed to revenues. There are 5 methods for evaluating investment projects. Those are beginning with the payback period, which is the number of years required for a firm to recover the initial cost of the project. The discounted payback period, which also represents the number of years to recover the initial cost, but only after paying the firm's investors their mandated return. Net present value, which is to compute all of the cash flow streams a project is expected to produce during its lifespan, discounted at the project's cost of capital. The internal rate of return. Similar to the NPV, the IRR, as a rule, if the IRR is more than the cost of capital for a project, the project is likely favorable. And lastly, the modified internal rate of return. Again, similar to the IRR, but the modified version accounts for the change in investment rates. Risk can also be evaluated here as well, utilizing the weighted average of the cost of capital, or WACC. Put simply, an above average risk project has an inverse relationship for the weighted average cost of capital increases, the project's net present value decreases. On the other end of the spectrum, a project that is considered less than average risk, the WACC decreases and the net present value for the project increases. To illustrate the usefulness of sensitivity analysis, here we have a simple P&L statement for the GIBSON's Widgets Incorporated. GIBSON's Widgets is not the industry leader, but has a healthy market share and is known for the quality in the widgets it produces. Working with the historical figures shown here on the slide for 2022, we have the price per unit. This price represents the consumer's price. Variable costs are those costs that can fluctuate, such as raw materials that GIBSON's purchases in the production of widgets, which can vary based on volume discounting. We have fixed costs, or those that remain steady, such as payroll, and then the projected sales, or in this instance, the known sales at 2,000 units. Here, through the computations, we have revenue at 400,000, cost of goods sold at 40,000, for a total of 360,000 of gross profits, and then we have an operating profit after we factor in fixed costs at 300,000. In order to apply a sensitivity analysis, the management at GIBSON's wants to see a 15% decline forecasted against its known numbers. In this instance, our independent variables are price, variable costs, fixed costs, and then sales. The 15% decline is applied against each one of those independently while leaving the remaining at their known constants. In doing so, we can evaluate what is the impact to the dependent variable, the operating profit. And from this, we see that the price to the consumer is most susceptible or most sensitive. We can dive into this with some further analysis, as seen on the next slide. We now know that the price is the most sensitive category in the widget business. At least that's the case for GIBSON's widgets. Based on the computations from the previous slide, we can now probe deeper into the category of the widget's price to the consumer. Given the basics of microeconomics and the principles behind supply versus demand, we can estimate that there is an inverse relationship between the price of a widget as it is offered to the consumer and the number of widgets sold. As the price increases, the number of units sold will decrease and vice versa. The table here represents changes to the number of widgets sold across the horizontal and fluctuations in the price along the vertical. The ensuing results within the table do represent operational profit, as cost of goods sold and fixed costs have already been factored in. As we can see, center mass is what Gibson's is currently enjoying at an operational profit of $300,000. On the extremes, if price rises to $300 per widget and Gibson's only sells 1,000 units, then the operational profit is forecasted to be $250,000. This is $50,000 less than the current. Conversely, if 3,000 units were sold, still at the $300 per widget price, then the operational profit rises to $750,000, an increase of $450,000. On the other side of the spectrum, if the price falls to $100 per unit and Gibson only sells 1,000 units, the operating profit that results is $50,000, a substantial loss of $250,000 off the present. And again, if 3,000 units are sold at $100, the operational profit is cut in half to only $150,000 of what it's currently enjoying. Armed with this information, the Gibson's Widgets Incorporated management is afforded the ability to make a concerted decision regarding its widget price, the need for robust cash stores, and to seek out new and inventive cost savings methods, all courtesy of performing a sensitivity analysis. In closing, this brief covered sensitivity analysis and its definition, the purpose as it is applied to business, the incorporation of capital budgeting, allowing for risk to be managed, and an example of sensitivity analysis applied. I thank you for your time. Please take a moment and review the references used in preparing today's brief.